Hey guys, I'm Joseph Graff, and today I'm going to be talking about 3 mistakes that dividend investors make. Dividend investing is a popular strategy because it allows investors to see income in the form of dividends, either monthly or quarterly. That being said, there are some downsides and some pitfalls to dividend investing, so I'm going to be going over some of those today. And without further ado, here's the video. The first mistake that some dividend investors make is investing in a stock just because it has a high dividend yield. The example I'm going to give you all today is Prospect Capital, ticker symbol PSEC. We're going to look at what would have happened if you would have purchased this stock 5 years ago in August of 2014. So if you would have purchased this stock in August of 2014, you would have seen that it has a 12% dividend yield. You could have purchased it for $10.73, and you would have received a dividend payment of about 11 cents every month. Now, 12% dividend yield is extremely high. To put that into perspective, the average stock in the Standard & Poor's 500 only pays about 2 or 3%. So like I said, 12% is extremely high. So now, if you would have purchased this stock at $10.73 in August of 2014, you would have only received a 3% overall return. Prospect Capital is now only trading at $6.56. So you would have lost over $4 per share in the value of the stock. Now, during that time, the stock did pay a little over $4 total in dividends. However, one of the negatives about this stock is that it has cut its dividend down from paying 11 cents every month to about 6 cents every month. Now, like I said, this represents only a 3% total return over a 5-year period. To put that into perspective, the Standard & Poor's 500 has returned about 67% in that same 5-year period. You would have been much, much better off investing in the Standard & Poor's 500 index fund than you would have been chasing this high 12% dividend yield that you would have got from Prospect Capital. What you need to look at as soon as you see a high dividend yield like this is you immediately need to go do more research. A lot of newer investors think that, I can achieve a 12% return every year just from buying this stock. It's simple. The dividend's going to be there always. It'll be perfect. Now, a more experienced investor would take a look at that and say, okay, wait a second, this seems really high, especially when this 12% dividend yield is 4 to 6 times higher than the 2 to 3% I could get from a Standard & Poor's 500 index fund. Now, a more experienced investor, like I said, would see this and say, okay, something's up. And then what they do is do some more research, and they'd find out that Prospect Capital is a business development company. Now, business development companies are a special group of stocks that typically pay very high dividend yields. They take money and they invest it in startups and various other projects, and a lot of their earnings is dependent on how well these other companies do. So they're generally regarded as one of the more riskier investments. They can be good investments in some cases, but like I said, you just need to do your research, and you'd see that Prospect Capital may not necessarily be a great investment, even though it pays a 12% dividend. The next mistake that some dividend investors make is that they invest in stocks just because it pays a dividend. So today I'm going to give you all the example of General Electric. General Electric, for the past 30 years or so, has been regarded as a strong company. It's had a pretty great dividend history. But as some of you all probably already know, in the last couple of years, it's run into trouble. Over the past 3 years, its stock has gone down from $30 to $10, and its dividend has also been cut multiple times to now it's only paying out 1 cent per share per quarter, or 4 cents annually. Now, like I said, General Electric was pretty widely considered to be a strong, very safe stock with a small chance of cutting its dividend. But if you would have done your research back then, and hindsight is 2020, of course, but you would have seen that there were certainly some problems with this company, and that maybe it would not have been a great investment to make. Now, like I said, it's easier to go back now and say, oh, it would have been a bad investment. But what I'm really trying to say is just because a company has paid a dividend in the past does not guarantee that it will pay that dividend in the future. The company's business model may change. There may be less demand for its products. There may be a new competitor who takes a big portion of the market share. And all of a sudden, this company that has done well for years and years and years is not doing as well anymore. So, like I said, just be careful when you're picking dividend stocks. Make sure that you like the company. Don't just invest in the company because it has a dividend yield you like. And like I said in part one, especially don't invest in the company just because it has a high dividend yield. The next mistake that some dividend investors make is that they don't invest in stocks because they have a low dividend yield. Now, it's easy to see a stock and say, oh, it's only paying out, 1% annually. Why would I invest in this? Well, a lot of times these companies are taking their earnings, and instead of paying it all out in dividends or paying a big portion of it out in dividends, they're reinvesting their money into the company to grow their company. Now, what this sets them up for is the potential to pay out higher dividends in the future. So today I'll give you all the example of United Healthcare. If you were to buy United Healthcare stock 5 years ago, you would have only had an annual payment of $1.40 per share, which was only about 1.7%. And as I mentioned earlier, that is lower than the average Standard & Poor's 500 stock, which is between 2 and 3%. So a unexperienced investor might have thought, this dividend yield is too low. I'm not even going to take a look at this stock. Now, if you would have bought United Healthcare back then and held on to it to this day, you not only would have seen a nice price appreciation in the stock's value, but you also would have seen an increase in dividend payouts. Now the stock is paying $3.78 per share annually. That's an effective yield on cost of about 4.6%, which sounds a lot better than that 1.7%. So this group of stocks that don't necessarily pay out a high dividend now, but have the potential to do so in the future, are called dividend growth stocks. And there's a whole investing strategy dedicated to dividend growth investing. And like I said, the whole premise behind this strategy is that you look for stocks that maybe don't pay the highest dividends now, but their companies have a lot of room to grow, and they have a great chance of increasing their dividends in the future. Now, this can be a very powerful strategy, and it's certainly something worth looking into. Stocks today like Visa and Apple, they are what you might consider to be dividend growth stocks. Both of them pay below a 2% dividend now, but based on their earnings and the amount of their earnings that they pay out as dividends, they have the potential to pay out more in the future. Before I go, I want to talk about one important thing to look at when you're considering buying a dividend stock, and that's the payout ratio. Now, the payout ratio is the percentage of a company's earnings that it pays out as dividends. So let's say we have a company and it earns $1 a year per share. Let's also say that company pays out 50 cents a year per share in dividends. Now, this company would have 50 cents divided by $1, a 50% payout ratio. Now, as you might guess, the higher this ratio is, the less safe the dividend is considered. So stocks with a payout ratio of around 50% are generally considered pretty safe, because if you think about it, they could have a 50% drop in earnings one year and still be able to meet their dividend payouts. Now, stocks that have a payout ratio of 80 or 90%, those are considered to be less safe dividend stocks. So, like I said, when you're looking at dividend stocks, definitely take a look at the payout ratio and make sure that payout ratio is something that you're okay with. Maybe you're okay with taking a little more risk and are okay with a stock that has a 80 to 90% payout ratio. Then that's fine. But maybe you're very reliant on this dividend and you need this dividend year after year. Then you're better off picking something around 50% with a 50% payout ratio, or maybe even less than that if you're really concerned about it. But thank you all for watching today's video. I hope you all enjoyed it. If you did, please hit the like button. Also, please subscribe to my channel for future videos. And thank you all. Take care.